Welcome to Profitability Thinking. Today's video is about how to determine your business's or business unit's break-even point. A break-even point is the amount of sales at which your business neither makes money nor loses money. It's important because it can supply you with a context about basic decisions you make in your business, kind of a reality check. Break-even analysis can also be used to do profit modeling, to project what your business's profits might be under different sets of circumstances, as well as determining the likely profitability of pricing, investment, and marketing decisions you make in your business. In order to explain break-even analysis, we first have to start with the income statement. The income statement, sometimes called the profit and loss statement, answers the question, did my business make a profit? It consists of revenue minus cost of goods sold if your business happens to sell products, minus operating expenses equals a profit or a loss. An example of an income statement is in the upper left-hand corner. As you can see, we have gross sales of $89,106. We have returns and allowances of $4,000, which gives us sales revenue of $85,106. We have cost of goods sold of $38,000, leaving a gross margin of $47,106, 55.3%. We have various kinds of operating expenses such as salaries, wages, commissions, benefits, taxes, office expense, rent, utilities, marketing, and so on. Total operating expenses, and adding those up, are $45,106, which leaves us an operating profit if we take gross margin of $47,106 minus operating expenses of $45,106 equals an operating profit of $2,000. We have interest expenses in this case of $2,000, leaving us a profit of $0. This business broke even. However, expenses can be categorized in different ways. One way is to classify them as variable expenses and fixed expenses. Variable expenses are expenses that increase or decrease with the level of sales. Some examples of variable expenses might be cost of goods sold, which increase or decrease with the level of sales, commissions the same way, variable labor, which happens if you have a service business where labor increases and decreases directly proportional to your sales, and shipping expenses if you ship to your customers at your expense. Each of these expenses increases or decreases with the level of sales. Variable expenses are typically expressed as a percent of sales or dollars per unit. Fixed expenses, on the other hand, happen whether you make a sale or not. Some examples of fixed expenses might be rent, utilities, salaries for the office staff, employee benefits, equipment leases, marketing expense, and interest expense. Each of these expenses happen independently of the level of sales. Fixed expenses are typically expressed in total dollars. An income statement can be formatted to account for these types of expenses. An example of such an income statement is in the upper right-hand corner up here. As you can see, as in the last income statement, we have sales revenue of $85,106. We have the same $38,000 in cost of goods sold. We have some other variable operating costs, which might be, in this case, shipping expenses or commissions, which leaves us total variable expenses of $45,106, 53%, which leaves us with something called a contribution margin. It's called a contribution margin because it is the part of sales that contributes to fixed costs and then to profit. The contribution margin is usually expressed as a percent of sales or dollars per unit. In this case, we have $40,000 in contribution margin, or 47%. We then have various fixed expenses, such as fixed operating costs and interest expense, which equal $40,000. We have a contribution of $40,000 minus fixed expenses of $40,000. We have the same profit of $0. Which gets us back to break-even analysis. The idea behind break-even analysis is that a business starts the month in a theoretical hole for the amount of its monthly fixed expenses, and a contribution margin from sales is applied to fill that hole until the hole is completely filled. At that point, the business is breaking even. Any contribution margin from sales after the break-even point is profit. To calculate the break-even point, take the total fixed expenses and divide by the contribution margin percent. In the case of the example income statement, we have $40,000 in fixed expenses, and we divide by the 47%, 0.47 contribution margin equals a break-even, as we had up there, of $85,106. The business started the month with a theoretical loss of $40,000 and a contribution margin of 47% from sales made up the loss until the business broke even at $85,106. To confirm, we can take our $85,106 break-even sales amount, multiply it by the 47% contribution margin, and if you have a calculator, that will equal $40,000. You can also use this type of calculation to project a profit at a different sales level or contribution margin amount or fixed cost amount. Let's take an example where the sales increased to $120,000, but the contribution margin stayed the same at 47% and the total fixed expense dollars stayed the same at $40,000. What would the profit be then? Well, we have an income statement here that shows that we have $120,000 in sales revenue. We have our cost of goods sold. We have variable operating costs, which leaves us the same 53% variable expenses, just a different number, $63,600. We have the same contribution margin percent, 47%, just a different contribution amount of $56,400. We have the same fixed operating costs of $38,000. We have the same interest expense of $2,000, which means we have the same total fixed expenses of $40,000, which leaves us with the contribution of $56,400 minus the $40,000 in fixed expenses equals a profit, in this case, of $16,400. To calculate, we take the $120,000 in sales, multiply it by a 47% contribution margin, equals the total contribution margin dollar amount of $56,400, minus the $40,000 in fixed expenses, equals a profit of $16,400. And we do better on the numbers, but okay, $16,400. This kind of calculation is very useful in determining the best of various pricing options, or the sales increase needed to justify an expense for marketing, personnel, or equipment. We will go over the profit impact of pricing decisions using these kinds of calculations in the next video.